right, a lot more oil rigs in the United States. Maybe you've noticed them dotting the landscape. Why? Because there's oil, there's a drilling boom in this country. Who couldn't love a drilling boom? Some of the oil services companies. Actually, it's very interesting. Liam Denning, Mr. Liam Denning, Heard on the Street columnist. You can see his column right there. It's in the paper. It's online. Explain to us what's going on. This is very interesting. You wouldn't think that this would actually have an adverse effect on some of these companies, but it kind of is.
Well, I think it comes down to the outlook. So I think oil services companies are basically the companies that rent out the equipment and the people and do the drilling for the exploration and production companies. Now, if you go back over the past decade, they've actually had a pretty good run at things because you had the whole shale boom, right. Which meant you had a huge amount of gas rigs running. It peaked out at around 2,000 rigs altogether in mid-08. Then you had the crash. But actually what happened then was lots of exploration and production companies said, okay, well, gas prices are very low, so we're going to try and stay away from drilling for that. But instead, we're going to drill for natural gas liquids, which are kind of like oil and command a higher price than gas, and crude oil itself. So what you saw was that a lot of those gas rigs got taken offline, but then repurposed to drill for oil. So the rig count is now actually back around where it was in the middle of '08, but it's now mostly oil rigs. Problem is, the way gas prices crashed was that gas companies effectively found loads of gas, they produced a lot of it, and hey presto, you had an excess supply and prices crashed. And the same thing is now happening with natural gas liquids. All the E&P companies have pushed so much money into drilling for that again, we've got excess supply. Right. So again, prices have crashed. And if you look at oil prices, which I know are up today a fair amount, although that seems to be more around a strike in Norway than anything else. Oil prices look, again, quite weak compared
they were
to
under 80 last week. Was it last week they were under 80?
Right. Yeah. And I think, a lot of people have gotten ahead of themselves in terms of, banking on some kind of European agreement to save the oil price. I mean, if you look actually cash prices, the prices people are actually paying for physical barrels didn't react in quite the same way as futures did last Friday, which is always a bad sign. So again, there's a weakening there. Now for the oil services companies, this is bad news because they've been relying on E&P companies to drill for lots more oil and natural gas liquids to keep these rigs running. And it looks like that's going to come off because these E&P companies are facing all sorts of pressures now in terms of low prices, the damage it's doing to their cash flows, and ultimately they're going to have to scale back their budgets. Well,
I mean, I know I've read, and you see, we're pulling up some of the stock prices. They're having some of these companies having a pretty good morning, actually. I mean, I know I've read that supplies are at all-time highs. Like there's almost nowhere to put this stuff anymore, right? I mean, that's an issue. Yeah. Right.
Right. Exactly. I mean, if you look at what happened with natural gas, we're still facing excess supply now, even though this has been talked about for at least 2 years. Because the thing is, if you're an E&P company, once you've contracted the guys in to drill the thing, you've contracted in water supplies, you've contracted in 30 or 40 other contractors for these wells. It takes a lot to make you pull the plug on a project. So even though gas prices are way down, it can take a while for that supply to actually switch off, and that's why we're still facing excess supply now.
Now, you started off talking about outlooks. What are the outlooks for these oil services companies?
I think what's going to happen is that the guys who are very exposed to the land side of the business, where most of the shale drilling is going on, they are currently priced for not much growth, i.e. investors have already seen that maybe drilling is going to level out. I actually think what's going to happen is rigs are actually going to get taken off because E&P companies, as they head to the third and fourth quarter, they're going to be having conversations with their banks saying, okay, well, our assets, which a year ago were valued at gas being priced at $3 or $4, those are now valued at $250. What are you going to lend us on the basis of that? And guess what? That number's going to shrink.
$250. I would love $250. I would love $250. We have to leave it there, Liam. Thank you very much for coming on.
Thanks very much.